Hello, and welcome to your July Investor Update. I'm James McManus, Chief Investment Officer at Nutmeg. In this update, I'll be looking at market performance in June, how we're currently positioned across our investment portfolios, and the opportunities that potential cuts to interest rates will bring. How did global equity and bond markets fare in June as we reach the halfway point of 2024? June offered investors mixed returns across global equity markets. At a broad level, global stock markets rose by 2.8% in sterling terms, yet many major European stock markets delivered negative returns. The performance of the global index was largely driven by performance in both the US and the Japanese stock markets, rising 3.6% and 1.7% respectively. In the US, the technology sector, and specifically those mega-cap technology-oriented stocks such as Meta and Amazon, led the way once again. In the UK, the FTSE 100 finished marginally lower, with losses of 1%, while medium-sized or mid-cap companies declined 1.9%. In emerging markets, meanwhile, they delivered relatively strong returns, up 4.3% in June, with Chinese stocks muted in contrast to the wider emerging markets. Returns in Asia were led by Taiwan, up 12.1%. And that's home to one of the world's largest computer chip manufacturers, Taiwan Semiconductor Manufacturing Company. Global bond markets also enjoyed positive returns in June, led by gains in government bonds as encouraging inflation data in the UK and US saw bond yields fall, and corporate bond markets also delivered small positive returns. How are Nutmeg portfolios positioned going into the second half of 2024? Well, we remain optimistic on the outlook for equity markets with a preference for the US and Japan, and that means that we're currently holding more equities in lieu of bond exposure across our managed portfolios. Now, we remain slightly underweight the UK relative to our long-term allocation due to the lingering impact of inflation and sluggish UK economic growth. The first quarter of the year confirmed that the recession was over, but the economy hasn't seen meaningful signs of acceleration, with mixed signals in recent business and economic activity. Within emerging markets, we've tilted our exposure away from the Chinese economy, where we see domestic growth drivers as challenged despite our expectation of a broader pickup in global trade activity. Now, that has historically been beneficial for trade-centric emerging markets, but China's domestic woes and the potential for the upcoming US election to resurface frictions with its largest trading partner mean we favour emerging markets outside of China in the current environment. More reassuring inflation data has raised expectations for central banks to cut interest rates in 2024. What opportunities will that present for investors? Well, high interest rates act like a brake on the economy. They slow activity and consumer spending, and as interest rates start to fall, there's the prospect then of increased economic activity. A simple example here is the housing market. Higher interest rates increase mortgage costs, and the rate of activity naturally slows. As interest rates and then consequently mortgage rates fall, we should see a pickup in housing market activity, people buying and selling homes, which in turn then generates further economic activity through the knock-on effects from DIY and furniture stores to legal firms and estate agents. A pickup in housing market activity will stimulate further growth. And that increased economic activity is exactly why central banks want to ensure they're confident inflation is under control before they reduce interest rates. Act too early and inflation could rise again as a result. Historically, high interest rates have constrained economies to the point of recession, but this time appears different. It's likely that central banks in the US and the UK will soon be cutting interest rates following the European Central Bank's lead with its first interest rate cut in June, with the global economy already on a growth footing. So we're positioning our portfolios to tilt towards sectors and markets that should benefit from a strengthening economic recovery and continued growth leadership from technology-oriented businesses. Thanks for watching. If you have any questions or suggestions for a topic you'd like us to discuss in next month's Investor Update, you can contact us via social media, email, or in the comments section below this video.